Hello guys, welcome back to another episode of Hot Money Topics. Now I did miss last month's episode because I was away in Broome sunning myself, but I'm back this month and there is a lot for us to talk about. Both the Australian stock market and the international stock markets have been quite volatile this month. The ASX, the S&P 500 and the Nasdaq are all down for the month, with the Nasdaq being hit the hardest, down over 5% for the month. There are a number of factors causing these shifts in markets lately, with the most notable probably being the Chinese property market. You've probably heard of Evergrande going around in the news lately, and that's one of China's largest developers, and also one of the world's most indebted companies with over 300 billion in liabilities. This has caused wobbles in stock markets all over the world because if Evergrande were to default, it's not just going to impact the Chinese economy, but it's going to have an impact on global economies as well. And this is because of the 300 billion that they owe, 20 billion is in dollar denominated bonds. So there's also going to be a big ripple-on effect of Evergrande defaulting. One of those ripples has been a significant hit to the price of iron ore. Back in May, iron ore hit a peak of $233 a ton, and today it's below half that, around $110 a ton. And this is largely due to weak Chinese demand for our iron ore. And if you've been invested in any of the big mining companies, well, you would have felt this pain in the stock price. FMG has dropped by over 40% from its highs in July, BHP has dropped roughly 33%, and Rio by nearly 30%. But let's put this into perspective. Even though there's been a significant drop in the price of iron ore, at $230 a ton, that was an anomaly. That was a lot higher than it usually is. And even the most recent federal budget put the price of iron ore at $55 a ton. So the current price of iron ore is still relatively high, and the big miners can make good profits at these levels. And I wouldn't be surprised if we see further drops in the price of iron ore. Now there is a flow-on effect of the drop in iron ore prices to the Australian dollar. The dollar is currently buying 72 US cents, which is down 2.25% for the month. This is partly because iron ore is one of our largest exports, and so when demand for one of our largest export items drops, then demand for our Australian dollar also drops. And it's also partly due to the US dollar being at a 10-month high, and that's largely driven by an increase in treasury yields as people are expecting adjustments in monetary policy. A lower Australian dollar is generally good for our exporters because it means that people around the world can buy our goods and services cheaper, but it's generally not so good for our imports because it means we have to pay more for the products that we're importing into Australia. And if sustained, this can lead to inflationary pressures. Not all commodities are doing bad. A lot of the base metals are actually doing really well. Cobalt is up 65% for the year, nickel is up 12% for the year, and lithium is up a whopping 254% for the year. This has a lot to do with demand for these metals in the production of batteries and electrical vehicles. I mean, there's a big shift at the moment towards a greener future, and these base metals play a crucial role in that. And that's why in our portfolios quite recently, we increased our exposure to these kind of resources. I did a whole video last month talking about alternative asset classes, of which one of them was a resources play that taps into these base metals. Now, I do think that's a useful video to go back and watch if you haven't seen it already, because it can really help out in these testing market times. To add to the concerns in the market at the moment is the US debt ceiling. Now, this is something that we've seen in the past, and again, it's a hot topic. And we're seeing headlines out there saying that basically the US could be headed for its first ever default. What the debt ceiling basically means is that there is a cap on how much the US government can borrow. And at the moment, in order to continue funding their bills, they need to increase that cap limit. But in order to do so, the Democrats and the Republicans need to agree, which, as you can imagine, isn't a smooth process. Now, my take on the situation is, in the 11th hour, they normally come good and they come to an agreement, and the debt ceiling gets raised again. Finally, one of the last points I want to talk about is the rising 10-year Treasury yield. This means that investors are selling out of bonds, and this is largely due to the fear of inflation. Jerome Powell mentioned in a recent speech that inflation is elevated and will likely remain so in the coming months before moderating. Now, I've talked about the risks of inflation to markets in the past, but just to recap, if inflation occurs and it's sustained inflation, then this is going to lead to a shift in monetary policy, and we're probably going to see interest rates rise. Now, when interest rates rise, it means that investors can start generating a return on their capital from more defensive asset classes like cash and bonds. So the stocks which are going to be hit hardest by this are going to be those growth type stocks which trade on high multiples, and that's probably why the Nasdaq has been hit the hardest. So there's a lot going on in markets at the moment, and in order for you to be a good investor, you need to work out what is noise and what is relevant, and then make tweaks to your portfolio for those relevant items. Now, it's never smart to go all in or all out, because at the end of the day, you could be wrong with your analysis, and also things change on a daily basis. So we're making tweaks to our portfolio, but they're just that, they're tweaks. But that's it for me today, guys. Thanks a lot for watching. If you learned something new, please hit that thumbs up button, and I will see you guys in the next one.